When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events. We'll answer your listener questions, and then finally, we'll talk about LIRPs, life insurance retirement plans, and how they very well may fit into your portfolio. My name's Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom is solid advice. They come from the other Jeff in this radio program. Of course, it's Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how are you doing today?
Doing great. How are you doing?
I'm doing great, thank you. Always glad to hear from you. Always glad to talk to our fine people here in the greater Tucson area. And also, happy Memorial Day. You're out there barbecuing. You've got an extra day off. Remember what Memorial Day really is, and it's paying tribute to those veterans who have made the ultimate sacrifice for our freedom. So remember what Memorial Day is all about. Jeff, let's start off current events by talking about strong earnings. They have really kept the stock market bulls in charge. What do you think could bring this rally to a halt, and if it comes to a halt, and when if possible?
I'm not going to back off from what I've said before. We're still in turbulent times, still a lot of uncertainty out there, especially with the tariff conversations. You know, we had Trump kind of back off the China deal and kind of, you can't count him out, but he did give in a little bit to China. That actually put the market at ease, but not really the market at ease. Based on what I'm seeing is a lot of the institutions are selling stock they bought cheap a few weeks ago, and now they're dumping it to the tourist investor, the person that kind of comes and goes because they hear something on the news and it sounds good. There are some sectors that seem to be okay. Some of the stocks that got beat up in the April mini crash are still undervalued, I think. I'm not going to start naming stocks. People start thinking that they're recommendations. Got some stocks that are back down to where they're fairly valued on a fundamental basis, and probably it's a stock picker's market, I think, right now, because there are some things that I think will weather any storms ahead a little bit better than the market overall. Although the big names and the market indexes have gone back up considerably. I mean, they've bounced back almost all the way back where they were. And again, the volume hasn't been incredibly good. There's still a lot of smart people that are betting on a retracement. You know, all it takes is just one little hiccup of bad news, and we'll start reducing shares and seeing a sell-off again. So I think we're still kind of in that cycle. Some of the things that worry me about the fact that we're testing the all-time high again typically means more often you take out that all-time high or test that all-time high. If we don't break forward and continue to move ahead and create new highs, we have to be careful that the next correction is going to be even stronger than the last one, and to not just test the next low, but actually go below that. And so again, there's typically 4 or 5 different cycles in a correction or a bear market. We hit bear, just touched it, in April. We bounced back because of some news. Again, I don't know that it's supported by a lot of buying. It's supported by earnings on a few companies. Earnings were estimated lower than they should have been because of the tariffs and all those questions. I think the stock market expected less earnings growth than they got. And that's good news that companies are still moving forward, and some companies are beating their expectations and still doing a reasonable amount of business. So I think economically, we're still seeing some recessionary pressures. We still have to be cautious. We can't afford to lose money. The market still is, in my opinion, overvalued. In the opinion of most smart people, overvalued. Most hedge fund managers are still very heavily in cash, including Warren Buffett, Berkshire Hathaway's company, although he stepped away and handed off the reins to new people. He is still kind of the mastermind of the market, and they're still in a lot of cash. So we have to respect that. We have to understand why they're doing that. And I think we have to make sure that the earnings continue to be strong and continue to grow rather than just kind of maintain themselves. So again, moving forward, we have to move forward with caution. I don't think we've had any really bad news this last week or so. It's been just kind of lukewarm, but enough to have the bulls and the optimism of Americans charge forward. I mean, we even had a little scare with Moody's lowering the rating of our bonds, like from A2, A1 or something.
Right.
It was not a big decrease, but it was nevertheless something that said, hey, our bonds aren't as strong. And I think there's a lot of people that are a little bit worried about that with the debt that we're in, with interest rates so high. Can we continue to afford to service that debt? Can we afford to continue to pay interest on those trillions and trillions of bonds that other countries and other people have bought? Or are we going to have this great reset and remonetization of our debt like Ray Dalio says? There's a lot of what ifs out there that we still have to get past. Even with that Moody's downgrade, the market opened up low and ended up flat to a little high that day. And even since then, it seems to have shrugged it off very quickly. It's amazing how resilient the attitude and optimism of Americans are, especially with our market. That doesn't necessarily mean it's a great time to buy. It just means that everybody has high hopes. I think the majority of the investors are glad Trump's in charge, and he's doing some things that look like, at least long-term, will put us in better footing for a great future. But in the meantime, it does not mean we bounce around where we're at in the market and don't make gains until earnings can catch up to where we are. Or do we have a reset to where fundamentals all of a sudden make sense again, and then we have this robust growth after that, after the correction and after the settling of the market to fair value? So I still think market will end up in fair value in the next maybe couple of years. It may happen in the next few months where we have a nice sell-off and we can say, hey, you know what, the market looks really good right now and the tariff problem solved and there's no more wars in the Middle East and Russia and Ukraine are friends and Israel's not bombing anybody right now. And if something like that happens, it's off to the races with the market. Everybody's feeling good and all the things that support a good market are in place. But until that happens, I think we need to go ahead and continue to be cautious.
Well, for the first time in 4 years, Americans' view of the economy has reversed a 4-year trend. In a new poll that Harvard University did for the first time in 4 years, the poll says that optimism has outpaced pessimism. As far as the American people go, they're very positive about this economy. And I think a stronger view on the economy could reshape consumer spending and investment confidence after years of COVID-19. Do you think that finally people are beginning to see the light here at the end of the tunnel and understand what Trump is really trying to do?
Well, I think they're understanding. They're hopeful. I mean, like I said, Americans, a country of optimism. We've always weathered storms and come out on top. So I don't think it's supposed to be any different this time. I do think that even though there might be, in fact, I think people perceive the economy better while the actual economic data was not good, and then finally came to grips with it probably in the last year or so and said, well, shoot, this is kind of weird. Just kind of a disconnect. The market's going up. The economy really isn't that good. I mean, eggs are $10 a dozen. Gas is too expensive. 29, 30% inflation. It hasn't gone down. It's going up slower, but that hasn't fixed the problem. And I think the reality is like, oh my gosh, things really aren't as good as they've been saying. And then the reality set in. And then there's this perception, and I don't know if the statistics have shown, although eggs are down and gas is down, and there's some things that make living a lot easier, but interest rates are up. To buy a house is harder. Houses have been sitting on the market longer and longer. It's a buyer's market, not a seller's market. I mean, there used to be such limited inventory. You could be a seller and get what you wanted for a house because there were just limited sellers and people still want to buy. Right now, nobody wants to buy because they can't afford the mortgage.
Right.
Unless they have cash. But who wants to buy their house? Because whoever's buying their house isn't in the market because the interest rates are too high. So there's still some things that need to settle down. I think we're going to have some interest rate decreases. I think there's no way around it. If nothing else, all the debt we have to refinance this year has got to be refinanced at a lower rate than 6 or 7%. It's not quite that high, but I mean, we can't keep having it head that way and then having all these U.S. bonds and treasuries be refinanced at a rate that, we can't possibly sustain going forward. So that in and of itself, plus I think the fact that in order to get the economy going, we've got to lower interest rates now. Keep in mind that all those things I'm talking about cause inflation. So unless we can create a supply issue where there's an abundance of supply, and I don't think that'll happen until manufacturing comes back to America, more people get really moving into creating goods and services. When the free flow of services comes back and forth to overseas, even China, once we get the tariff settled, because a lot of stuff still comes from China. Even if nothing else, the parts that we use in some of the things that we want to manufacture here are going to have to come from foreign countries, at least for a little while. They can't all be built here. So until that happens, I think there's going to be some fairly serious inflationary pressures that go along with the reduction of interest rates. So we have to be careful about that. Inflation and those kind of things also hurt businesses and profits. So, let's see how it shakes out. But I don't think we're out of the woods yet by any means. I think reality isn't necessarily what reality is. It's a reality maybe just what people perceive it is. And if people perceive that the reality is awesome and the economy is going to the moon, they might keep throwing money at the market and push it to the moon. So we have to be conscious of that. And sometimes it's good just to follow the money, even if it isn't smart money, even if it's just money, because money does make the world go round and it makes the market go up and makes the market go down if there's not enough buyers, if there becomes an abundance of sellers. So I think vigilance is really where we have to be. I think there's enough perception of good things. However, if you look at the prior market crashes, they always follow periods of extreme optimism. We've had a couple of times like that, and we've had some corrections, and all of a sudden we get this extreme pessimism, and that's when the market rebounds and goes up like it has in the last month or so, right after the extreme pessimism in April. So the fact that we're getting more optimistic the last few days may be a sign of a good time to sell. Sometimes we can refer to John Templeton, who has a lot of great quotes about the market, but it's, his whole idea was, hey, buy when everybody's selling and sell when everybody's buying. And if you do that, you'll be a rich man. And I think he was a rich man. I mean, his funds did great for a long, long time. Still around. Actually, Franklin Templeton is now the brand that I hear Templeton with a lot. But Templeton also said, remember the 4 most dangerous words in the stock market or in investing. And those are, it's different this time, because it never is. The market repeats, the cycles repeat. Things that have happened before will happen again. We just don't know the timing on those things. And sometimes we think it's different because it didn't happen in exactly, 6 weeks from that date that the yield curve inverted or whatever. There's just these different things. And people say, well, the average time frame is this, and we're not within that average. Well, so we're just skewing the average a little bit. Sometimes we're going to always set a record of a higher high, a lower low, or a longer term between events. And those just continue to morph the averages into a different fact or set of facts for the future. But the fact is we're still making history, and we're still seeing history repeat over and over again. So, we can't discount that. We have to move forward with being wise and not being foolish.
Talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Our show, of course, is called Premier Retirement. We're talking about current events, and we're talking about the market, the economy. Moody's rating downgrade this past week here on Monday, I believe. They downgraded the country's rating from, I believe it was AAA or AAA to AAA1. Ray Dalio warned that Monday's Moody downgrade of the U.S. sovereign credit rating understates the threat to the U.S. Treasury. And he said that the credit agency isn't taking into account the risk of the federal government simply printing more money to pay its debt. He says you should know that the credit ratings understate credit risk because they only rate the risk of the government not paying its debt. What do you think about Ray Dalio's comments? Does he have a hidden agenda in all of this, or is he just basically telling you the truth?
Well, I think Ray Dalio is a historian. This guy has been around forever, and he's probably one of the most noted authorities on credit cycles and things. I mean, I would believe him and I'd take him at his word. I would not discount it. And I don't think he has any ulterior motives. The guy's wealthier than anybody needs to be, has made billions and millions of dollars managing the biggest hedge fund on the planet. He's smart money. I mean, the guy knows what he's talking about. And I don't know what ulterior motive he would be playing unless he just plans to buy bonds cheap because he wants the bond market to crash so he can buy cheap. I don't know why he would do that. I think he's probably already in bonds or has been. And we'll get in bonds when the time's right. I've seen other countries. I mean, he's seen other countries. We've seen, he relates some of the stuff back to the Roman Empire of how big and fat they got at the top, and the elitists just kept taking money from the peasants and the serfs, and pretty soon there wasn't any more to take, and they got all decadent and amoral and just kind of went off the deep end, so to speak. Kind of like if you look at our country, it's following kind of in the same similar pattern where you just get a little overexuberant. You don't really care about being responsible with money. And it can eventually blow up. So, we've seen the pigs countries, the Portugal, Italy, Greece, and Spain 20 years ago or so. They had to remonetize their debt because they were just way over their head in debt. I mean, on a comparison basis, we're not quite there yet in America. I think we're well over 100% debt to GDP, but it's not like 200 or 300% like some of these countries have gotten to in the past. I don't know that we'll get there anytime soon, but we're headed that way. And I don't know that Ray Dalio, he might think it's closer around the corner than I do, but the fact that he thinks it could happen is something that we really should be a little bit more at least aware of or conscious of and say, things aren't as rosy as maybe you hear on the news. They're just trying to prop up the market and lead the market because they're getting paid by advertisers that are from Wall Street. And so, you have to consider the source. I think Ray Dalio has probably less of an agenda than people on the news who are getting paid by advertisers telling them what to say and what they can't say and telling them who their guests on their shows can be and who can't be. It used to be people that were doom and gloomers got kicked off the shows and never came back. Guys like Harry Dent, he was talking about the roaring 2000s and, it didn't happen in America. They thought he's just a bozo. But what happened is there was, free trade agreements, and most of that growth happened around the country because unfortunately instead of making everything here like we used to, we shipped it all overseas, but the growth still happened worldwide. The economy still grew. People still got rich. But he also, was talking about in 2008, there might be blood in the street. There's some bad things happen. Nobody wanted to hear him until it happened. And then he doesn't get to be on the news. But the guys that say, oh, bye, don't worry about it. You got these guys, Jim Cramer is just a showman that I don't think he makes a stock, but probably 3 out of 4 stock picks are bad picks, or they're late or early or don't make any sense. But, he's a showman and people follow his advice. Well, it's not even advice. He even says on the show, it's not advice. So again, I think there's a lot of things you can see on TV that I would consider agenda driven or money driven or advertising driven, or for whatever reason, just driven by other motives than, hey, let's see if my advice can make everybody rich. I think Ray Dalio's being a cautionary voice out there that needs to be heard. But whether it comes to fruition to the extent that he's claiming, he's kind of like the sky is falling kind of a guy when it comes to remonetizing or the debt crisis. And it's happened around the world. It's happened in history. It's happened in recent history in other countries. So we can't discount the fact and say it can't happen here just because we're Americans. I think it could happen here. We've got to do things to mitigate that. And I think Trump is the guy that'll probably do as much as anybody could to try to make that happen. I don't think the track we were on before the election was a good track. And I think Ray Dalio would have been a much more close to being right than he may be if Trump has his way and gets the trade balanced again and gets us in a position to pay our debt down and lowers taxes so the economy thrives, instead of the government just taking our money and throwing it down a black hole someplace and not creating goods and services and economic benefit for the American people.
If our listeners would like to have a casual conversation here, Jeff, with you at Premier Retirement, we're offering it to you. You can get it by calling 520-780-9059, 520-780-9059. You can make that call right now if you want. Leave your name, telephone number, and Shelley will give you a call back during the week and find a convenient time for you to sit down and talk with Jeff. Of course, he can take a look at a retirement plan that you already have, but also if you have questions about what we talked about today, the market and the economy and where things are going in the rest of 2025, have that conversation with Jeff. It's not going to cost you a dime, no obligation. Once again, 520-780-9059. You can find out more about our firm online if you'd like at primret.com. Jeff, as far as the outlook goes for the rest of the year, here in another month or so, we're going to be halfway through 2025. The market is in a wait-and-see mode as investors watch for signs of economic distress. That is what I'm reading on NASDAQ.com. You do not have a crystal ball. I do not have a crystal ball. But what is your best educated guess as to the way that things will shake out here for the rest of 2025 as far as the market goes?
Well, I think it's going to be choppy. I think it's going to be flat or even down. I think most of the big banks have also called for a reduction in their expectations for where the market is. I think it's kind of at its high for the year, maybe go up a little bit, bounce around there. But I think it's going to be a reset period, whether the market is choppy overall or we get a sell-off that becomes a little bit more pronounced, have that reset that I think a lot of the smart money's thinking about. And the best way to get around that is to have most of your money you need to use for living as expenses, et cetera, is to not have it in risky accounts that can go down and lose value. I like principal protected accounts that still go up when the market does well. So if I'm wrong, we're still right. We can still make money. But I would be very cautious this year thinking that unless you're really picky about the stocks you buy and looking for value stocks and being, I think it's a stock picker's market if you can be that person, or if you can hire a good money manager that can keep you in those things that are fairly valued and have uptrends and have momentum and have growth prospects, even in spite of the recessionary factors that are lingering out there. Then there's still money to be made, but I don't think just parking it in an index is probably as good a play this year as it was last year. And again, last year I didn't think it would be either, but it was. So again, I'm not going to, you said if I had a crystal ball, I wish I did. Well, if I did, I wouldn't be doing this job, right? Trying to, guess it and help people navigate the unknown. But it is unknown. That's just the fact. The fact is nobody has a crystal ball. And it's funny how many people think, well, gee, Jeff, you're an advisor. You should have known the market was going to go up 20% 2 years in a row. Well, when the last time it happened was in 98, 99, right before the 2000 crash, and then it crashed for the next 3 years. So if that's any telltale sign of what might happen, we just had 2 really good 20 plus upside years. Does that mean the next 2 or 3 years we're going to have that crash? Well, if history repeats just from the last time it happened, maybe so. Let's not discount the fact that these things can happen. Sometimes we get a little bit over exuberant or over confident or over optimistic and don't see some of the writing on the wall. So again, there's several cycles that show that we're in a multi-bubble bubble. Bubbles always pop. If they can pop, but we can have some sort of a soft landing because all of Trump's goals and all the things that we hired him for the job for come to fruition, and he gets all kinds of support across the aisle, et cetera, which I think is a long shot. then maybe we have a better chance of that soft landing. But I just think going forward, I'm not going to try to guess the market. I'm just going to say, hey, there's a lot of pressures to say that it has a really high probability it'll go down or flat than up. So if that's the case, then are we positioned to weather that storm? Now, are we also in a position to take advantage if I'm totally backwards and wrong? And I want to be in that place to where we're right either way. And I think our clients are positioned that way.
Jeff, we can't end this conversation without talking about tariffs. Walmart warned customers that they're likely to start feeling a more significant impact from higher prices because of tariffs in the coming weeks. And Trump told Walmart to eat the tariffs rather than pass them along to consumers. Aren't we seeing a weakening of our trade partners because of the threat of tariffs from President Trump?
I don't know. We'll have to see. I think that companies are going to have to, in certain aspect, eat the tariffs. I mean, there's plenty of profits. I'm not saying that any corporation shouldn't do well and shouldn't have earnings and shouldn't be able to pay their employees and their executives big bucks, and also, make a decent return to their shareholders, which is also important. I think that all of that has to be kept in balance. And I realized if we can save money on gas, if we can save money on taxes, if we can save money on interest and pay an extra dime or 15 cents for an item at Walmart, then it really comes out a wash and everybody benefits. But there's going to be some places where we spend more and some places where we spend less. It can't all go down. I get that. But inflation was happening without all this tariff talk during the last few years, and especially a couple of years ago when the market was plummeting and inflation was going through the moon. We had 25% over the course of a little over a year. And it hasn't gone back. So we're already paying more for everything. I guess we're kind of getting used to that. But if it can be offset with deflation on those things that we can either make here, not pay tariffs, or on the goods and services that companies here can export, because now the tariffs we have a more even playing field where companies here can actually export some of their goods and make money to either pay higher wages, which makes them able to pay more for goods and services at Walmart. Trump wants to pass this big, beautiful bill that we're trying to get everything, taxes lowered permanently. If they go out of whack, that's like a $4 trillion tax cut that's gone away. That's a huge, now some people might think, well, we need that to pay down the deficit. Well, guess what? They won't pay down the deficit. They'll just find a way to spend the money. That's what they always do. The other thing is if it's not given to families, then there's less money to be spent and to support the Walmarts and the other companies that do business and provide goods and services to all of us. And if they're going to have to charge a little bit on tariffs for all the items they sell and people are buying less items, guess what? They're going to have to charge more tariffs on the few that they do sell. And that'll create more inflation for those people that do have the money to spend. So it's not really a good situation to pay more taxes, because we're still going to have to pay more taxes, have less money, and end up having less to spend on those goods that might be impacted by tariffs. Nobody ever said tariffs would not impact, to a certain degree, products and services here. But I think I mentioned one time about the avocado. Some guys saying, better buy them quick, man. They're going to go up. The tariffs on Mexico, 25%, whatever. But, if that avocado costs 70 cents in the store, the farmer that sold it in Mexico got a dime for it. So if they charge 25%, that avocado only goes up 2.5 cents. Mm-hmm. And if gas gets cut by 25%, guess what? Transportation is like 50% of the cost of that good. And then the rest might go to profit and overhead for the store. So did it really go up? So can you afford to spend 72 cents for an avocado instead of 70? I think most people are okay with that if the economy stays better and we save taxes and we all have jobs and manufacturing comes back and our kids can get jobs and life can get better overall. I don't think that 2 cents is going to make a big difference. You can add it up amongst the millions of things that you buy over the course of your lifetime or the hundreds of thousands that you buy during the year, but it all adds up. But it also creates more free flow of money, and the money momentum, that money moving through the system over and over again, is what creates economy and well-being for everybody.
If our conversation resonates with you, you would like to sit down with Jeff, have a conversation about the market, the economy, the tariffs, how they affect you, or just anything that relates to your journey towards a confident retirement. Once again, we're offering you the opportunity to do that with our Premier Retirement Roadmap. No cost, no obligation. 520-780-9059, 520-780-9059. You can make that call today. Leave your name and telephone number, and Shelley will call you back during the week to set up that appointment. 520-780-9059. You can also visit us online at premret.com. Jeff, time for a break here on Premier Retirement. When we come back, we'll be answering listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premred.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
Happy Memorial Day. We so much appreciate you joining us here for Premier Retirement each and every weekend on 790 KNST. We're here for you 4 times a week. You can hear us on Saturdays at 7 a.m., 9 a.m., also 1 p.m., and then you can hear us again on Sundays at 11 a.m. If none of those times are convenient for you, you've heard something that you want to hear again, remember, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You can also Google that and find our podcast there. It'll guide you at any number of places that you can hear it. You will be hearing that program and helping you on your journey towards a confident retirement. And again, if you'd like to come in and sit down and talk with Jeff, 520-780-9059, 520-780-9059. Make that call. No cost and no obligation for that. No judgment. We'll meet you where you are. Okay, Jeff, time for listener questions. And let's kick it off this week. We have Ian listening to us in Tucson. Ian says, I'm 68 and retired now. My wife is 66 and also retired. Combined, we get $5,000 a month in Social Security. I have $600,000 in equities and $100,000 in cash equivalent accounts. I do not have a plan for long-term care. Is it too late to try to solve this long-term care problem?
Well, not necessarily. I mean, most people have a house. Many times they consider their house as their long-term care problem solver. You've got equity. Most people, by the time they get to long-term care age, have paid off their house. Not everybody, but let's just say you're on track for that. If you've got $600,000 in equities, you got some nice cash, making a decent income, I'm guessing maybe your house is paid off. If you own your home, that equity can always be reverse mortgaged and used, even if you ran out of money. Now, $600,000 and $100,000 in cash, if you're not spending, if the $500,000 is covering all your bills, I mean, you're going to have plenty of money to cover that just with your own cash flow. But if for whatever reason you do end up using that $600,000 or the $100,000 for income and it's all gone, there's still that backup plan of the house. The other thing is, I don't like long-term care plans to buy it, you use it or lose it type thing, where you pay premiums and every 5 or 10 years they jack the premiums up to where you're finally 90 years old, you think you might use it, and then they increase the premium so high you can't afford the policy anymore. You drop it and then you end up needing it and don't have it. So insurance companies, I think, are a little predatory that way. They really kind of count on a lot of lapsing or a lot of people not using their long-term care insurance, and they force you out of it by raising the rates the older you get, unfortunately. So that's kind of honestly, I have a bad taste in my mouth for long-term care policies that work that way. I prefer to pay it with asset-based long-term care. There's versions of annuities and life insurance that you can buy that, no matter what, pay off the balance of the account or even a death benefit additionally upon death. And if something happens to you before you die and you have to go to a nursing home, long-term care, have some sort of a chronic illness, you can tap into those funds, either penalty-free or maybe even double or triple the funds of what you put in if it happens to be used for long-term care. The thing is, that gives you a chance where you never can lose your money, but you can get a bonus for whatever reason if you end up using the long-term care. Now, the insurance companies know that not everybody's going to go to long-term care, so they can offer these additional benefits on a big percentage of those policies, as long as not all of them end up cashing in on those extra benefits. And they can actually figure that all out. They're big boys, they stay in business, but it's a way for you to transfer that risk and not at least be out any money. One of my favorite ones is really the LIRP, the life insurance retirement plan, where you can, depending on if you've paid tax on that $600,000 or not, or if you want to pay tax on an accelerated basis, let's say you took, half of that $600,000 and took it out and put it into a LIRP, maybe for each of both you and your wife. You're still young enough to where it might play out. That money would be kind of like having a tax-free bank where, let's say if each of you put $150,000 in one of them, you would have probably $400,000 in death benefit or long-term death benefit should you need it. The other thing is, as long as you're not touching that money, then the interest that you make on the cash you put into this policy grows, pays all your bills, and could possibly continue to grow on a pretty significant basis. If that's the case, you can also borrow that money or actually use that money to live on or spend it on bills should you need it for other things. So it doesn't have to be used just as a death benefit. It can be used for extra cash flow if you need it. You can take it out on a tax-free basis because you're actually borrowing against the death benefit, which is a tax-free death benefit. You're just using it while you live. So that's truly, in my opinion, life insurance instead of death insurance, but it can also be used for long-term care. So I think there's still a couple of options for you to look at. that don't include spending a lot of premium, because at your age, the premiums for a pay-as-you-go policy isn't cheap and would probably cut into your lifestyle a little bit, at least for your cash flow, especially if you're trying to live on the $5,000 a month Social Security plus required minimum distributions and other things that are going to be required out of the other money if it's in qualified plans like IRAs or 401ks.
And Jeff, we're assuming that Ian does own his home being at that age. What about a reverse mortgage? If Ian wanted to do that, what are the considerations that he should be aware of there?
Well, a reverse mortgage, a lot of rich people are using it actually. With interest rates as high as they are, they're actually loaning less money as far as the equity. But let's say you have a $600,000 house, they might loan you somewhere close to half of that. So they would loan you $300,000. You could use that cash to fix up your house and age in place and hire your own caregivers to come and take care of you. And the thing is you don't lose your house when you do that. You just have a mortgage against the house. And so let's say the mortgage, you borrow $300,000, and by the time you pass away, you owe $400,000 to the bank that loaned you the $300,000 to, live your final days and pay for your long-term care. So, you borrowed $300,000, you end up using it for long-term care. If you owe $400,000 because you borrowed $300,000 plus the interest, you owe $400,000, but your house is worth $750,000. Guess what? Your heirs still inherit the $350,000 that's left if you hadn't spent the whole amount that they loaned you or gave you. If, however, you took that money and invested it and did really well with it, maybe you paid for your care without using it up, and maybe it grew to $400,000. Maybe you just pay off the bank with the $400,000 and give your house to your kids free and clear if they want it, or they just sell the house, take the equity, and keep the other $300,000 or $400,000 you invested with the reverse mortgage money. Again, there's plenty of flexibility in a reverse mortgage. It's not as ugly or weird or bad as some people think it is. The only thing is there are some fees up front, but hey, you know what? They're insuring you against your house, something that the bank doesn't own or can't get at until you die. There is some risk there, and so you do have to pay a little premium for that risk. But at the same time, it allows you to use money that you wouldn't otherwise be able to use. Many times, if you're retired and don't have enough income, you can't do a home equity line of credit or even do a regular mortgage on your house, which is another thing, a cash out refi you could do as well. But then again, if for whatever reason you live long enough and your loan grows, you have a payment on the loan that you take out. On a reverse mortgage, you don't have a payment. Depending on your situation, you may wish to try both ways, but I think the reverse mortgage is definitely something more people ought to look into.
Ian, thanks for that question. We appreciate you listening to us in Tucson. And again, if you'd like to talk to Jeff on a one-on-one basis, 520-780-9059. Make that call this weekend. Leave your name, telephone number. Shelley will call you back during the week and set up a good time for you and Jeff to talk. And of course, you'll be getting Jeff's book, Retirement: The Road Ahead. Next question, Michael listening to us in Catalina Foothills. Michael writes, I'm 64 and want to retire at 67. I currently have about $700,000 in my 401k. I'm not even sure of the allocation or what it's in. How can I make my portfolio more income focused in retirement?
Well, I think you can probably start right now on those 401ks. You don't have to leave a 401k as a 401k in most cases after you're 59 and a half. It can be moved to an IRA that you self-direct, and you can create a situation where you can guarantee a certain amount of income with that. For example, maybe you like having $700,000 in your 401k that you can use in the future, but you have no idea if it's still even going to be worth $700,000 in 3 years. What if we do go through a recession? What if we do have a market meltdown? What if we do have another 9/11? What if we do have a war in the Middle East and, Trump gets assassinated, we get some stupid president that doesn't know economics or something? I mean, heaven forbid. There's all these weird what ifs there's all kinds of crap that can happen that we can't know before it happens. And we need to be prepared for all that stuff. So could your account actually be worth less than $700,000 in a few years? Yeah, a lot of ways. What if you could lock it in or lock in a major portion of it, maybe $500,000 into something that would guarantee you an income value in 3 years of at least $800,000? And that they would pay you out 5% of that a year of the 800, even though you only put 500,000 in, they would pay you 50,000 a year roughly for the rest of your life, or maybe $40,000 a year for the rest of your life, guaranteed. Well, that's an income plan you can count on. You can do that right now. The market's at a high point. I mean, it's near an all-time high. Why not take money out at an all-time high? If the market keeps going up, these income products continue to go up as the market does well. If the market goes down, they don't go down. In fact, they continue to grow at a guaranteed rate of return while you wait to take income. Even if the market stinks, even if all those horrible things that happen, the world turns upside down on its head, as long as the lights aren't off and money doesn't work anymore, it's still guaranteed. And believe me, I think of all the entities on the planet that are the safest and the ones that if the world ever did melt down financially, the last ones turning out the lights would be insurance companies. I mean, banks would be gone. brokerage firms would be out of business. Most of the places, a lot of people are making investments wouldn't even be able to find their money, but insurance companies have money, they have reserves, they have assets. They're kind of the last straw as far as security, in my opinion. To bank on your lifetime income with an insurance company, I think is a great thing. We love indexed annuities because they go up when the market goes up. They also don't lose money in bad markets. So the insurance companies can guarantee, if they know they're not going to lose money on your money, they can guarantee you a certain amount of income. That's more than you can guarantee or even guess at in the stock market, bond market, or wherever your 401k is. And if you don't know where it is, I would either find out or look for options as far as income options. And I will pretty much guarantee, I've never seen a 401k offer an income annuity. And so if you want to do those type of things for income planning, you need to do that yourself. What they do offer is what they call fixed income allocations, which are really nothing more than bonds. But we know what's happened to bonds in the last 2 or 3 years. I mean, they've gone down 20 or 25%, all the while they're paying you 3 or 4% interest. Well, the interest doesn't offset the losses you made on that account if you need to start using that money for cash. So a bond portfolio, we have learned, is not the way to go for income. And even though for a few years it was, because as interest rates went down, those bonds actually increased in value. Plus you got the interest and everything, life looked hunky-dory fine for a few decades. But now we're in the opposite end of that cycle, and it doesn't work that way. Why not let an insurance company take that risk off your shoulders, guarantee you income, let them make the investments and take the investment risk? They've got time. They can wait out the bond market. They can wait out these cycles. You can't because you're using your money every month to live on in retirement. They can because they've got a 100-year plan and they don't need all their money next week. They just need enough to pay the few people percentage-wise in their business that need income every month. That's all. And they've already got a plan that'll support that. So consider some options. 401ks aren't the only way to build. They're a great way to build wealth. They're not a great way to structure income or to protect wealth or protect that income during retirement. There's other ways. And that's why people like me are in business, because we help people transition from that buy and hold, build and dollar cost average into the market and build some wealth. We're into the protect the wealth, structure an income plan, save taxes, and make sure it's there for you when you need it for those paying the bills, long-term care, or to pass on yours when the time is right.
Michael, we appreciate you listening to us in Catalina Foothills. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. And if you'd like to talk to Jeff, 520-780-9059, no cost, no obligation for that casual conversation. All right, Jeff, the final question this week. Bill, listening to us in Sabino Canyon. Bill says, I'm 67 and plan to marry for the second time. I'm a widower now. I have a substantial nest egg, about $1.5 million. I have 3 children. My wife-to-be is also 67 and also has 3 children. She owns a modest home and has about $300,000. How do I protect my retirement savings to make sure that it goes only to my children when I pass? This has been on my mind because it's such a touchy situation to address before marriage. How do I approach this?
Well, I don't know how much you've told her already. If she already knows you have the money, you cross that bridge. But if you haven't, then you can set up a trust where you put the kids on as beneficiaries and trustees and make all those assets that you want to preserve for them in your trust. You can also suggest she do the same without even saying how much. I'm guessing if you know how much she has, she probably knows how much you have. So, she married you so that she can give half of her kids half of your assets. Well, I hope not. I hope it's more than because of you. And given the fact that, you built that wealth with their mother, I'm guessing. So now you're a widower. I'm sorry to hear that, but happy and congratulations on finding a new soulmate. So hope it all works out in the best way. But I know money situations can sometimes create a little bit of contention and can be problematic in any marriage, whether it's your first, second, or third one. But bottom line is, I think you probably ought to hash it out and just make sure each other knows how you're going to do things. And it's not a uncommon situation that I've seen often is on second marriages and stuff. Some people keep whatever came into the marriage prior to the marriage is, just in trust or put with beneficiaries on for that person's children, and vice versa with the other spouse. And then everything you do together, like maybe you buy a house together from those assets or from your Social Security, from those payments, you have kind of a different allocation on who pays what bills so that it's not like one person's going to substantially draw down their nest to amass greater wealth at the detriment of one spouse. So again, there can be some sort of amicable arrangement where you share costs or where you have a common account that everything you make from here on out just goes into a nest egg, and that's 50-50, and you just pay all your bills from it, whether hers is more than yours, less than yours, or the same. Doesn't matter. It's just whatever income you make. And also, if those required minimum distributions from IRAs and different things are what you have to take, then maybe those go into your common account and you share that as well. And just the residual is what gets passed on to those heirs. Again, you're at the same age. You've got kind of the same situation as far as when you're going to be required to draw that money out from the required distribution. I'm not sure how much is in IRAs and how much is in other assets, but I think a good solid discussion and maybe even an understanding with some bullet points or even a statement of understanding where you both acknowledge it, even sign it and say, hey, this is how we're going to live until we make this document null and void. This is what we're going to live by, and we both agree to this. Let's agree not to fight about it ever again or talk about it ever again. Now, I don't know. I'm just coming up with ideas that I've worked for some of my clients in the past. I'm not a marriage counselor. I'm a financial advisor. I could tell you how to create income streams and save taxes on your money once you're married and what your tax rates are going to be and all that kind of thing. So I might not be cut out for this exact answer. Probably help you in all the rest once you get this sorted out, though.
Bill, thanks for listening to us there in Sabino Canyon. And Jeff, I think probably a lot of your job is psychology as much as it is finance, trying to find out what makes people tick. But Bill, we appreciate you putting your trust in us and listening to us in Sabino Canyon. We invite you to give us a call here at 520-780-9059. If you'd like to talk to Jeff, 520-780-9059. Sit down and have a casual conversation. I'm sure that we can come up with an answer for you. You're listening to Premier Retirement with Jeff Ogan. Once again, if you'd like to talk to Jeff, we are offering this Premier Retirement Roadmap at no cost and no obligation. That telephone number, 520-780-9059, which you can call this weekend. All you got to do is leave your name, telephone number. Shelley will call you back during the week and set up a time for you to talk to Jeff. No cost and no obligation. 520-780-9059 or online at premret.com, PREMRET.com. Jeff, often on this radio program, we talk about LIRPs, life insurance retirement plans. They're a type of permanent life insurance policy, sort of like an index universal life or maybe a whole life insurance, used as a tax-advantaged retirement savings vehicle. Let's talk about some of the pros and cons of LIRPs. First of all, one of the big advantages, I think, of a LIRP, and correct me if I'm wrong, is tax-free growth. Can you comment on that?
Well, I can comment on all the tax advantage of it. It's a multi-tax advantage. Tax-free growth. Once you've paid tax on money, you get to choose whether or not you ever want to pay tax on that again. If you invested in a CD, for example, or in a dividend stock, you're going to continue to pay taxes on all the growth that that asset provides. If you put it in a LIRP, you can park money in there. And after you pay the cost of the LIRP, now the cost of protecting your assets and saving taxes, there is some costs involved, and I'll explain those too. But it grows tax-free. Probably the more important thing is if you die, whatever growth is in there also passes on tax-free, unlike an annuity that can grow tax-free if you don't pull it out, but is taxable on death to whoever does pull it out. On a LIRP, life insurance retirement plan, those death benefits are tax-free, so it stays tax-free if you never touch it. Now, so you say, yeah, well, what if I want to touch it? Well, then you have to pay taxes on the gains, right? No, not right. If you fund a LIRP correctly, that means you fund it over time. There's kind of a rule of 7 pay, but you can actually do it quicker the older you get. They kind of give you a little bit of flexibility. But as long as you don't just lump sum, park the money there and say, hey, I'm going to use this as my tax-free money bucket, you have to fund it over, let's say 4 or 5 years minimum, probably 5 to 7, maybe even 10 is probably the longest you want to fund it. You want to stuff as much money into this thing as you can, buy as little life insurance as you can, meaning if you get hit by a truck, what's it going to pay? Well, the insurance company is on the hook for the amount between what you put in and what they pay out in a death claim. So the smaller amount of death claim, in other words, the smaller amount of insurance you buy, the cheaper this policy is going to be for you. So the idea is not to sell you a ton of insurance. The idea is to buy as little as you can in order to play the tax game that is associated with permanent life insurance. And by the way, I like indexed universal life, not whole life. Whole life just doesn't seem to be efficient. Whole life gives you a guaranteed minimum rate, but they usually charge you more rates when you take the money out. And you kind of have to keep a lot of insurance in the policy. With an index universal life insurance policy, I like that because you can buy less insurance, meaning lower costs. And when you decide you don't want to pay it anymore, generally speaking, you can lower the insurance even more to even have less costs going forward. So you can minimize the cost over the next few decades that you use this LIRP pretty significantly if you use the right product. And there's a myriad of products out there in every flavor you can think of and every company you can think of. So depending on your goal, we would pick a LIRP or a life insurance product that would generate what you want to look for. Some people just want a big death benefit for their kids. In that case, overstuff it and pay a big death benefit when you die. And you can put 100% of your money in there if you want to. However, if you want to use your money for income, the cool thing about a LIRP, unlike a Roth IRA, is just like a Roth IRA, you pay tax on the money either from an IRA and you convert it to a Roth, you pay the taxes now and you never pay tax again. But if you take money out of a Roth, the money's gone out of the Roth. If you use money that's in the LRRP, you don't actually have to withdraw it. You borrow against the future death benefit. So a loan does not generate a 1099. A loan is not taxable, just like a Roth distribution is not taxable, even though the IRS does know you took Roth money because there is a 1099 that just says you took a distribution, but there's no taxes due. So it still may be cause of concern because it may still look like provisional income and may cause other things in other tax situations to go up. Whereas a LRRP, it's just a loan against a future death benefit that's tax-free, doesn't create any tax event, doesn't show up anywhere except in your bank account. And the money that you spend is still in the policy growing because you never took it out. You actually borrowed against the death benefit, and that cash value continues to grow and compound daily, monthly, or annually, however your policy is set up, so that it exponentially grows. The longer you have it, the more money you can borrow tax-free. And in some cases, if you live long enough, you can take 2 to 3 times out of that policy of what you put in. And that may or may not include the income that you take out in actual spending money that you don't have to pay taxes on, as well as the death benefit or the long-term care benefit. I mentioned earlier in one of the questions that there's a way to pay for your long-term care insurance out of the death proceeds from an insurance policy. You just do what's called accelerated benefits. You get to accelerate your death benefit early because if you're going to a nursing home, the company knows they're going to have a death claim soon anyway. They might as well pay you 90% of it now and then charge you interest against the rest of it so that they may not have to pay out as much. It's a good business decision for them and it's a convenient idea for you to have that money while you live rather than wait till you die and just make somebody else rich all the while you suffer and don't have access to your money because you want to let somebody else take over all that money and you not use it. I think you should be able to use your death benefit as much as the next guy. In fact, you should be number 1 on the list and that next guy should be plan B, not plan A. So again, if you set up a LRRP because you want to generate tax-free growth and tax-free income and a tax-free death benefit, that will likely and could very well give you more money than a Roth conversion would without the risk that you'd probably have to be taking in the stock market or bond market, things that can go up or down, and be removing your money when you use it. With a LRRP, you don't take the money out. It continues to compound. We can use principal protected strategies, which only go up when the market goes up and they don't go down when the market goes down. Last year, for example, the market was up over 20%. Some of our LRRPs were up over 15%. They lock that in. If the market goes back down 20% this year and we give away last year's gains, guess what? The gains in the LRRP stay in there. You just don't make any this year. So there is a way with these LRRPs to actually beat the market if the market's going to be choppy for a prolonged period of time. Most LRRPs would have beat the stock market between 2000 to 2010 because we had 2 big market corrections and we had about as many up years as down years. Well, the up years would lock in profits. The down years don't lock in any losses. So again, I think there's tons of economic benefit, retirement benefit to LRRPs. I like the tax-free nature. I like the income that we can plan for that doesn't cause you to go in a new tax bracket. It can be steady income or it could be just a withdrawal anytime you need to buy something and you don't want to go into a new tax bracket by taking extra money out of your IRA or something like that. It could be that simple. But bottom line is LRRP should be looked at as maybe one of those boxes, a tax-free income box or kind of like a tax-free bank account that you can use at will and it never affects your tax returns.
So, Jeff, when you talk about tax-free growth and tax-free withdrawals, I am all in. You're speaking my language. Talking with Jeff Ogden of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, talking about LRRPs, life insurance retirement plans. If you would like to explore LRRPs a little bit more, you're not having these sort of conversations with your current financial advisor, you'd like to talk to Jeff and explore whether or not a LRRP may be right for you, give us a call here at Premier Retirement. 520-780-9059. 520-780-9059 is our telephone number. You can make that call this weekend. Just leave your name, telephone number with Shelley. Tell her you'd like to talk about LRRPs. She will give you a call Monday and set up an appointment that is convenient for you. Once again, 520-780-9059. Absolutely no cost. It's just a casual conversation. There is no obligation. You can also find out more about us online at premret.com, PREMRET.com. Jeff, out of time for this week. Thank you so much for your time. Happy Memorial Day, everybody, and be sure to join us again next week right here for another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.